Hello crypto enthusiasts, and welcome to the FinShark Updates, where the latest finance and crypto news and updates are brought to you. When the central bank raises interest rates, it's a big headline. It can send ripples across the whole economy. It is the primary tool used by the central bank to manage inflation in the economy. In this video, we will reveal why the central bank raises or cuts the interest rate. So what is the interest rate and what is inflation, and how does the interest rate help in controlling global inflation? What is inflation? Inflation is the rise in the price of goods or services. It results in a decrease in the value of money. Let's understand with a simple example. Suppose you buy 1 kg of oranges for $5 in 2021. If inflation hits the economy by 8%, for example, the price of the same 1 kg of oranges will be approximately 5.5% in 2022. It means you cannot purchase any product or service by paying the same amount. Likewise, in an economy where prices of all essential goods and services increase due to inflation, these can affect the economy in the long term. What is the interest rate? If you borrow money, you will have to pay a little extra to the lender to make it worthwhile for them. This is the interest rate. The lender, on the amount loaned, charges the interest rate. The interest rate is the amount charged on the principal amount by a lender to a borrower for the use of the asset. The asset can be cash, equipment, a house, a car, or other assets. So if you want to borrow money from the bank or any other lender, you would like to keep the interest rate as low as possible so that you don't have to pay much back. On the other hand, you can earn more of the savings if the interest rate is high. How does the interest rate help in controlling global inflation? When the central banks raise interest rates, they are trying to control inflation. Let's see how the interest rates help control the economy's excess inflation. When the central bank increases interest rates, the change spreads through the financial system and slows the inflation rate. Here's how. A rise in the interest rates from the central bank means that the commercial bank will earn more on its reserves. They might make some more from keeping their money in a central bank than lending it out. So if they do lend it out, they will raise the interest rates to make it worth more. It affects consumers' spending sentiment. Higher interest rates mean higher borrowing costs. Higher borrowing costs leave fewer dollars in consumers' hands, reducing their purchasing power and spending less. When they spend less, businesses try to avoid increasing the prices of their goods or services, which leads to slower inflation, which is the primary objective of central banks in raising interest rates. On the other hand, if the interest rate rises, savers earn more of their savings. It encourages people to save more and spend less, and it leads to slow inflation because of the spend less, save more behavior of consumers. Not only consumers who will tighten their pockets, but businesses also. When the interest rate rises, businesses will find it more expensive to borrow and invest the money, which means less economic activity. It might mean fewer jobs are created. For households, fewer jobs and lower wages could mean less money, and consumer confidence might suffer, which also means less spending. Finally, lower spending will lead to lower inflation. Why have central banks raised interest rates lately? The New York Fed president said he's not expecting a recession, but acknowledged much uncertainty surrounding the outlook. Federal Reserve Chairman Jerome Powell said interest rates would continue to rise until the central bank sees clear proof that inflation is slowing, but conceded that elevated rates could lead to a recession. We've got to get interest rates higher, and we need to do that expeditiously, Mr. Williams said. In terms of our next meeting, I think 50 basic points or 75 basis points is going to be the debate among policymakers, although the data will drive the actual size of the rate increase, he said. The Fed is tapping the brakes by increasing interest rates to reduce demand. We are working as fast as we can towards that goal, and hopefully, Americans across the globe will begin to see some relief in their wallets, Williams said, adding that the economy will slow but not stop rising. The Fed hiked rates by 3/4 of a percentage point earlier this month, the largest increase since 1994, to a range of 1.5 to 1.75%, in order to combat 70-year high inflation. Dali stated last week that she feels another 75 basis point rate rise is necessary next month. John Williams, the New York Federal Reserve Bank president, also said that he sees the need to act quickly and decisively to limit inflation. We need to move expeditiously, Williams said in an interview on CNBC regarding our next meeting. I think 50 basis points or 75 will be the debate. Both Daly and Williams predict the unemployment rate to rise by a few tenths of a percentage point from its present level of 3.6%. Still, they both said that the labor market is strong and economy has enough momentum that they do not expect a recession. On Tuesday, June the 28th, Reuters, Federal Reserve policymakers promised further rapid interest rate hikes to bring down high inflation. Still, they pushed back against increasing fears among investors that sharply higher borrowing costs would trigger a considerable downturn. Many are concerned that the Fed would operate too firmly and throw the economy into recession. Mary Daly, San Francisco Fed president, said in a LinkedIn interview, "I'm concerned that if inflation persists, it'll be a serious constraint and threat to the U.S. economy and its sustained progress." The Fed is therefore tapping the brakes by raising interest rates to cool demand. "We are working towards that as fast as possible, and hopefully Americans will start to see some relief in their wallets," she added, saying that she expects the economy to slow down but not stop growing. In an essay published Tuesday, St. Louis Fed President James Bullard pointed out two previous situations. In 1983 and 1994, when the Fed increased rates without causing a recession and said the central bank would strive to follow the model. The Fed's forward guidance that more policy rate hikes are expected in the coming months is a deliberate effort to assist the FOMC more rapidly change policy as necessary to bring inflation back in line with the Fed's percentage objective. The Federal Open Market Committee, FOMC, is the Fed's policy-making body. Consumer confidence in the United States fell to a 16-month low in June due to inflation fears, according to Confidence Board statistics released Tuesday, a signal that they're keenly monitoring. Getting people to feel comfortable that the money they earn today will pay for the products they need tomorrow, that is no longer something people feel confident in, and we need to restore that trust, they added. Thank you for taking the time to watch this video. Don't forget to smash the like button and subscribe for more crypto, Web3, NFT, and finance videos.